Hi guys, it's Dale with e-Insurance. Today we're going to talk about an article that applies to small to medium-sized businesses, in particular those that are in an industry where it's heavily a contract is heavily utilized, right? So your contractors, your landscapers, your movers, things like that. The article's called Liability Insurance versus Surety Bonds, right? Um, Both are extremely important to small to medium-sized businesses that work within that contract world. And to really to start, it's probably best just to look at the literal definitions of these two terms. Liability insurance is probably the easier one or more common one, and that's simply, let's say you're in an accident, and a third party's property or a third party is damaged, right, or hurt in some sort of way, and you're found to be responsible for that damage. You're found liable for that damage. You then would have to pay for that damage. That's where liability insurance comes in. Surety bonds are quite different in that it's essentially a promise to a third party, right, i.e., the customer, that a second party, i.e., the small business, the contract company, right? Let's just say it's a landscaper for this example. It's a promise that the second party, the contract company, will actually keep its obligation, i.e., contract, to fulfill for the third party, right? So it's a promise that the company will actually abide by the contract, right? So kind of convoluted. So let's kind of look at an example to flesh that out. We've all probably hired movers either personally to move our homes, or to move a small business, or just to move a large item. And if you think about it, if any of the items that are being moved is damaged, if another party's property is damaged during the move, then 9 times out of 10, the movers will be found liable. In such scenario, the mover's liability insurance would kick in and pay for said damage. But let's look at another scenario. Those same movers start their move. In the middle of their move, they get tired, and just say, you know what, I'm done. I'm exhausted. And they leave. But only a portion of your items are actually moved. In this case, there's no real accident, there's no real damage, so there's no real liability in kind of a traditional liability insurance sense, but your items aren't moved yet. The project is not complete. In such a case, surety bonds come into play, right? Because a surety bond provider would then make up that balance, right? Make up the items that aren't yet moved, would either pay for them, hire somebody else to finish it, etc., right? And this is basically why you see companies within that contract industry advertise that, hey, not only are we insured, we're also bonded, right? Just to give the customers a bit of comfort with hey, it's a given if we damage your property, we've got the proper limits to repay you, or if we damage a third party's property while moving your stuff, we can also cover that. But it also shows that, you know what, we stand by our words because we're bonded, and we actually stand by the contracts that we write for you. We will not leave a job until it's done. We will fulfill that contract that we signed and promised to you. which is promised by our bond provider, right? Our surety bond provider. Hopefully that was helpful. If you own a small business, you definitely want to get both of these, liability insurance and surety bonds. It will help you in terms of attracting customers and being able to charge a higher rate for that. And hopefully you come back next week. Thank you. Bye.